In 1983, an unusual advertisement appeared in the Wall Street Journal. It wasn't about a stock tip, a new investment opportunity, or a get-rich-quick scheme. It was just a few lines of text, easy to miss, yet it would quietly ignite one of the most fascinating experiments in trading history. An experiment that would redefine what it meant to succeed in the markets. The ad read, "Richard Dennis accepts applications for the position of commodity futures trader to expand his group of traders. Mr. Dennis will teach successful applicants his trading methods. Successful candidates will then trade solely for Mr. Dennis. They will not be allowed to trade futures for themselves or others. Traders will be paid a percentage of their trading profits and will be allowed a small draw. Prior experience in trading will be considered, but is not necessary. Applicants must send a resume and, in 10 words or less, answer the question, 'What makes you tick?' It was simple, almost cryptic. Yet over 1,000 people responded. They came from every imaginable background: investment bankers and engineers, blackjack dealers and taxi drivers, PhDs and high school dropouts. Each one saw in that small ad the chance to learn from a living legend, a man who had turned 1 of 600 into more than 200 million in the futures markets. His name was Richard Dennis, and his story was already the stuff of financial folklore. Dennis had started as a runner on the floor of the Chicago Mercantile Exchange, a quiet kid from the South Side who borrowed money from his family to begin trading. Within a few short years he had amassed a fortune through sheer intellect, systematic methods, and iron discipline. He believed markets were not random, they followed patterns, and if one could follow the rules and manage risk, profit was inevitable over time. But his longtime friend and business partner, William Eckhardt, disagreed. Eckhardt was convinced that true trading success required something innate, a psychological edge, a gut feel that couldn't be taught. The debate between them grew until Dennis finally proposed a wager. He would prove his point by taking people with no trading experience, teaching them his system, and turning them into successful traders. If he was right, it would show that skill in the markets was a matter of training and discipline, not natural talent. Dennis called his experiment the Turtle Project. Inspired by a visit to a turtle farm in Singapore where he'd seen turtles raised in controlled conditions. He believed traders could be raised in the same way, cultivated through structure and method. From the 1,000 applicants he chose 23. They were an unlikely mixie, a 19-year-old named Curtis Faith, a quiet accountant named Jerry Parker, a few mathematicians, a handful of teachers, even a former blackjack player. They gathered in Chicago in December 1983. Uncertain of what lay ahead but united by curiosity and ambition. For 2 weeks Dennis and Eckhardt trained them. They taught them a set of mechanical trading rules now known as the Turtle Trading System. The system was elegantly simple: buy when prices broke out above a certain range, sell when they broke down, cut losses quickly, and let winners run. Every element was quantified: entry points, exit signals, position sizing, risk per trade. Emotion and opinion were irrelevant. They were taught to think in probabilities, to accept that losses were not failures but part of the process. Dennis emphasized that consistency was everything. Even a mediocre system followed with discipline, he said, will outperform a brilliant one that isn't. The lessons were not merely about numbers, they were about psychology. Dennis drilled into them that most traders fail not because they lack knowledge but because they cannot control their emotions. Fear makes them cut winners too early. Greed makes them hold losers too long. The Turtle rules were designed to neutralize emotion. A trader's job was to execute, nothing more. After training, Dennis gave each of them a trading account with real capital, sometimes as much as $1 million. Their task was simple: follow the system precisely. The early weeks were brutal. Some of the new traders panicked when the markets moved against them. Others second-guessed signals that seemed illogical. Dennis reminded them that logic and comfort had no place in trading. If you wait until a trade feels right, he told them, you'll always be too late. Slowly, as they trusted the process, the results began to change. Losses became smaller, winners ran longer, and the system's edge began to emerge. Within 4 years, the Turtles collectively earned more than $100 million in profits. Curtis Faith, the youngest of them, made $31.5 million by the age of 23. Jerry Parker would go on to build Chesapeake Capital, managing billions of dollars. Liz Shevel, one of the few women in the group, achieved financial independence by 45. Mike Carey turned an ordinary government salary into a legacy for his family. The Turtle experiment proved Dennis right. Great traders could be made. The difference between success and failure wasn't intelligence, luck, or even technical skill. It was discipline. The rules they learned were public, but few outside the group could follow them for long. Most people lacked the psychological endurance to obey the system through streaks of loss and doubt. The real lesson wasn't about breakouts or moving averages, it was about mastering the mind. At its heart, the turtle story is about the eternal struggle between emotion and logic. Markets are mirrors reflecting human nature: fear, greed, impatience, overconfidence. The turtles learned to silence those impulses. They didn't trade because something felt right. They traded because their rules said to. Each decision was a test of detachment. Could they take a loss without anger? Could they sit through profit without pride? Could they trust a system when it made them uncomfortable? Those who did became legends. Those who couldn't washed out quietly. Richard Dennis's experiment reshaped the way the trading world thought about talent. It showed that anyone could achieve extraordinary success if they had a defined system and the discipline to follow it. Yet it also exposed how rare true discipline is. Most people crave certainty. They want to be right. The turtles were trained to think differently, to focus on the process, not the outcome. They understood that the market rewards consistency, not perfection. Every trade was just one small event in a long series of probabilities. Losses were data. Wins were evidence that the system worked over time. Even decades later, the turtle principles remain powerful. In a world dominated by algorithms, AI models, and high-frequency systems, the core truths Dennis taught still apply. Technology can process information faster, but it cannot eliminate emotion. The greatest challenge in trading today is the same as it was in 1983: mastering oneself. Rules can guide you, but only discipline can save you. The legacy of the turtles is not just in their profits, but in what they revealed about human behavior. They demonstrated that success in any field, trading, business, life, is not the result of innate genius but of repeated, disciplined execution. They showed that confidence should come from preparation, not prediction, and that resilience grows through the acceptance of uncertainty. The true battle was never against the market, it was against impulse. When the experiment ended, many of the turtles went their separate ways, building firms, managing funds, or retiring young. Richard Dennis himself eventually stepped back from trading, but his philosophy endured. The system had worked, yet what mattered most wasn't the formula. It was the mindset. The story of the turtles remains a quiet testament to the power of discipline over talent, structure over chaos, and logic over emotion. It began with a simple argument between two friends in a Chicago restaurant. One believed traders were born, the other believed they could be made. That argument led to an experiment that created some of the most successful traders in modern history. Their achievements proved that mastery is not a gift. It is a decision, repeated every day, in the face of fear and doubt. The turtle experiment stands as one of the clearest demonstrations of a universal truth: success is teachable, but only to those willing to obey their own rules with unwavering commitment. Markets will always be unpredictable, but human behavior never changes. The turtles learned that discipline is the ultimate edge, and that lesson remains timeless. In 1983, at Le Colonial Restaurant in Chicago, Richard Dennis and William Eckhardt sat across from each other, engaged in a debate that would become legendary in the history of trading. Dennis was 34 years old, already a market phenomenon. Starting with only $100,600 borrowed from his family, he had turned it into more than $200 million trading commodities. His reputation on the Chicago Mercantile Exchange floor had earned him the nickname, the Prince of the Pit. Across from him was Eckhardt, his close friend, partner, and intellectual equal. He was a mathematician, philosopher, and chess master, known for his precision of thought and belief in the power of innate ability. The disagreement between them was not about money, but about human nature. Eckhardt believed that successful traders were born with a special intuition, a rare instinct that could not be taught or replicated. To him, trading was an art, not a science. Trading can't be taught, he argued, his voice calm but absolute. You either have it or you don't. It's like perfect pitch or natural athletic ability. Some people are simply wired for it. Dennis disagreed completely. His own rise had been the product of structure, not spontaneity. He believed that trading was a discipline built on logic, rules, and probability. Success, in his view, depended not on intuition but on the ability to follow a system without emotional interference. I could take anyone, Dennis replied, and teach them to trade successfully. The difference between winning and losing isn't talent, it's discipline. Their discussion continued for hours, measured and analytical but growing in conviction. To Dennis, markets were not mysterious, they were patterns of behavior governed by consistency. He believed that anyone who could follow his set of mechanical rules could succeed. Eckhardt remained unconvinced. He viewed Dennis's success as something deeper, an innate sensitivity to market rhythm that no classroom could produce. Eventually, Dennis challenged his friend to put the question to the test. Let's settle it, he said. We'll make an experiment. I'll prove that great traders are made, not born. Eckhardt agreed, not out of arrogance but from genuine curiosity. Both men were scientists at heart, and the only way to end the argument was through evidence. Dennis decided to conduct an experiment unlike anything done before. He would select a group of people, most with little or no trading experience, and teach them his exact trading system. After training them, he would give them real capital to manage and see whether they could produce consistent profits. It was not just a wager between friends, it was a challenge to the idea of talent itself. A few weeks later, an advertisement appeared in the Wall Street Journal. It read, "Richard Dennis accepts applications for the position of commodity futures trader to expand his group of traders. Mr. Dennis will teach successful applicants his trading methods. Successful candidates will then trade solely for Mr. Dennis. They will not be allowed to trade futures for themselves or others. Traders will be paid a percentage of their trading profits and will be allowed a small draw. Prior experience in trading will be considered but is not necessary. Applicants must send a resume and, in 10 words or less, answer the question, 'What makes you tick?' The response was immediate. More than 1,000 people applied: investment bankers, mathematicians, gamblers, students, even taxi drivers. Dennis reviewed each application carefully, looking not for experience but for mindset. He sought people who could think independently, accept uncertainty, and follow instructions without hesitation. From this vast pool he selected 23 individuals. They came from diverse backgrounds. Among them was a 19-year-old named Curtis Faith, a quiet accountant named Jerry Parker, a few statisticians, and several complete beginners. Most of them had never traded before. Yet Dennis was confident that if they learned his principles and applied them with discipline, they could succeed. His partner, Eckhardt, remained skeptical but intrigued. He respected Dennis's intelligence and precision, but he doubted that ordinary people could maintain composure under market pressure. To Eckhardt, trading was as much emotional as intellectual. It required a certain internal stability, a combination of nerve, intuition, and experience that no rule set could replace. Dennis disagreed. His trading philosophy was grounded in systematic rules. He believed that traders failed not because their systems were flawed, but because they could not follow them consistently. To him, success was a matter of behavior, not brilliance. The goal was to remove emotion from every decision, buying when prices broke above a defined range, selling when they fell below it, cutting losses quickly, and letting profits run. Every trade was a probability event, not a personal statement. The experiment would soon test these ideas in practice. The group of chosen students would later become known as the Turtles, after Dennis's remark that he could grow traders just like they raised turtles in Singapore. Over the next 4 years, these students collectively earned more than $100 million. Many went on to become some of the most successful money managers of their generation. But that night in Chicago, none of that was known. What began as a philosophical argument over dinner became one of the most famous experiments in trading history. It was a challenge not only to the myth of talent, but to the limits of human discipline. The question Dennis posed to his friend would echo long after the experiment ended: are traders born, or are they made? The response to the advertisement was overwhelming. More than 1,000 envelopes arrived at Richard Dennis's Chicago office, each one a small act of hope. Doctors tired of medicine, lawyers disillusioned with law, gamblers searching for a legal thrill, housewives seeking independence, mathematicians, musicians, programmers, soldiers. The applications came from every direction, united by one belief that this experiment could change their lives. Dennis and Eckhardt spent weeks reviewing them. But they were not looking for resumes filled with financial experience or Ivy League credentials. Dennis made that clear from the start. "I don't want professionals," he told his assistant. "I want people with no baggage. People who can follow rules without trying to be smarter than the rules." The criteria were unlike any traditional hiring process. Candidates were evaluated not on experience but on mindset. Could they handle being wrong most of the time and still execute their system without hesitation? Did they understand that trading was about probability, not prediction? Were they capable of following rules under emotional pressure, when fear or greed clouded judgment? One written question eliminated more than half the applicants. If you could take a 55% chance of winning $1,000 or a 45% chance of losing $1,000, would you accept the bet? Most said no. They focused on the loss, not the expectancy. Dennis wanted those who said yes, the ones who understood that long-term success comes from repeated small edges, not from avoiding pain. From over 1,000 hopefuls, only 40 were invited to interviews. They came from ordinary backgrounds. There was Michael Cavallo, a 31-year-old government auditor who had never owned a single stock. "I like rules," he said. "Tell me the system and I'll follow it." Jerry Parker, A soft-spoken accountant from Virginia explained his motivation with quiet conviction. I'm tired of making other people rich. I want predictable growth, not a random paycheck. Then there was Curtis Faith, just 19, the youngest of all. A programmer by trade, he impressed Dennis immediately. Trading is just logic, he said. Then statements with money attached. Computers do it without emotion. So can I. Others brought different kinds of drive. Liz Shevel, who had worked as a trading assistant fetching coffee for brokers, spoke bluntly. I've seen men make millions doing what I can do better. I just need someone to teach me the method. Jim Melnick, a sound engineer, gave a cryptic but revealing answer to the question, what makes you tick? He wrote, solving puzzles nobody else can solve. The interviews were long and unconventional. Dennis asked about how they handled loss, how they reacted to randomness, whether they could pull the trigger on trades that scared them. He wasn't looking for confidence, he was looking for composure. By the end of the process, 23 people were chosen. They didn't know it then, but they were about to experience one of the most intense 2 weeks of their lives. In that short time, Dennis and Eckhardt would attempt to turn ordinary people, clerks, accountants, and hobbyists, into disciplined traders capable of managing millions. Dennis named them turtles, after visiting a turtle farm in Singapore. We're going to grow traders like they grow turtles there, he said. Slowly, systematically, perfectly. Excitement and doubt filled the air as the group gathered for the first day of training. Some believed they were about to uncover the secret formula of wealth. Others wondered whether any formula could exist at all. But all of them sensed that something historic was beginning. Next came the first lesson. A simple truth that would shake everything they thought they knew about markets. January 2, 1984. Chicago Board of Trade Building. 23 nervous people in a conference room. Richard Dennis walks in. Forget everything you think you know about markets, he began. Your opinions are worthless. Your predictions are garbage. Your intuition is your enemy. The room was silent. This wasn't what they expected. We're going to buy high and sell higher. We're going to sell low and cover lower. We're going to lose money 60% of the time and get rich doing it. Michael Cavallo raised his hand. But isn't the goal to buy low and sell high? Dennis smiled. That's what everyone thinks. That's why everyone loses. We're not investors hunting for bargains. We're traders following trends. Big difference. He turned to the whiteboard and wrote teach com tarti elitradien jes ystem. This is it. Everything I'm going to teach you fits on this board. The entire system that made me 200 million. Entry rules: System 1 buy 20-day breakout, exit 10-day low. System 20 buy 55-day breakout, exit 20-day low. Add units at each half M profit for pyramiding. Initial stop 2N, which means 2 times average true range. Exit on 10 or 20-day reversal. Never move stops away from position. Position sizing. Unit size equals 1% of account divided by N times dollar value per point. Markets to trade. Bonds, currencies, commodities, indices, everything liquid. That's it. Jerry Parker asked. That's the whole system. That's it? Dennis confirmed. But knowing the recipe doesn't make you a chef. The difference between you and losing traders isn't information, it's execution. Curtis Faith was scribbling notes furiously. What about fundamental analysis? Economic reports. News. Worthless, Dennis said flatly. The market has already processed every piece of information better than you ever could. Price tells you everything you need to know. For 8 hours that first day, Dennis demolished every trading myth. Technical analysis. Tea leaves in astrology. Fundamental analysis. Stories to justify random moves. Market prediction. Impossible and unnecessary. Discretionary trading. A go disguised as strategy. By day's end, the turtles' minds were reeling. Everything they'd believed about markets was being systematically destroyed. But Dennis wasn't done. Tomorrow, he said, we'll talk about the real secret, position sizing. Get it right, and you can be wrong most of the time and still get rich. Get it wrong, and you can be right most of the time and still go broke. As you process this simplicity, you might feel resistance building. Good. That resistance is what keeps 95% of traders from ever implementing what actually works. Day 2 of turtle training. The room was quieter than yesterday. The energy had shifted from excitement to curiosity, from disbelief to anticipation. Richard Dennis walked in carrying 2 briefcases and placed them on the desk. Inside these, he said, are 2 truths. One will make you rich. The other will make you broke. Can anyone guess which is which? The room stayed silent. The turtles leaned forward. Dennis opened the first briefcase. It was packed with papers, charts, graphs, indicators, complex systems, colored analysis. This, he said, is what 99% of traders obsess over. Entry signals, indicators, news, analysis. It's worth maybe 10% of your success. Then he opened the second briefcase. Inside was just a single white sheet of paper with one simple formula typed neatly across the middle. Position-sized account $1.01 or dollar per point. This, Dennis said, tapping the page, is worth 90% of your success. This is position sizing, and most traders never give it a moment's thought. They want to predict, they want to be right. But the market doesn't reward being right. It rewards staying alive. He turned to the whiteboard. Let's do a little experiment, he said, drawing two stick figures labeled Trader A and Trader B. Trader A, the amateur, $100,000 account, thinks gold is going up, buys 10 contracts because he's confident. Gold drops $50. Normal volatility, his loss, $50,000. Half his account, gone. Game over. Then Dennis pointed to the other side, Trader B, the SERM account, same signal, but he calculates his position size using the formula. N equals 25, 1% risk. That means 4 contracts. Gold drops the same $50. 2 times N lost $2,000. Just 2%. He lives to trade another day. Dennis underlined the two figures. Same market, same trade. One destroyed, one survives. The difference, position sizing. Mike Carey spoke up. But what if Trader A was right? What if gold went up instead? Dennis smiled. Good question. Let's see. He wrote quickly on the board. If gold rises $100, Trader A doubles his account. He's a hero. Trader B makes $4,000, just 4%. Looks like Trader A wins, right? Wrong. Because we don't measure success in one trade, we measure it over 100. He began scribbling numbers that filled the board. Trader A, random sizing, wins half the time, gains 100% on wins, loses 50% on losses. After 4 trades he's broke. Because one double loss wipes everything out. He turned to the other column. Trader B, systematic sizing, wins only 40% of the time, average win 10%, average loss 2%. After 100 trades, account doubled, consistency wins. The amateur needs to be right about direction, timing, and size. The turtle only needs to follow the formula. Curtis Faith looked up from his notes. So, position sizing is risk management. Dennis shook his head. No, position sizing is the strategy. Everything else, entries, exits, systems, that's just execution. The math of survival is the math of compounding. You don't win by knowing where the market will go, you win by controlling how much you lose when it doesn't. He began explaining N, the mysterious variable that would become the backbone of the turtle method. N is volatility, Dennis said. It tells you how noisy the market is. You calculate it by taking the higher of 3 numbers, today's high minus today's low, today's high minus yesterday's close, and yesterday's close minus today's low. Then take a 20-day average. That's N, the average true range. He wrote examples on the board. If sugar is moving $500 per day and bonds move $300, should you risk the same dollars? The class shook their heads. Exactly. You risk the same percentage. You size down when markets are wild. You size up when markets are calm. The market tells you how much to trade. You just listen. Then Dennis dropped the next truth. And when you're winning, you add to your winners, systematically, not emotionally, not randomly. You pyramid into strength. You never add to losers. Ever. The room was silent. Every turtle could feel the weight of what he was saying. It wasn't just numbers. It was philosophy. Discipline turned into math. Survival turned into strategy. Dennis looked around the room and continued, his voice steady. Most traders blow up not because their system is wrong, but because their position size is. They risk too much when they feel confident and too little when they're afraid. Confidence and fear have no place in sizing. The formula doesn't care how you feel. He paced slowly in front of them. That's the beauty of it. When you size correctly, every loss is just 1 unit of pain. Nothing fatal. Nothing emotional. You stop thinking in dollars and start thinking in risk units. That's when you become free. Because freedom in trading doesn't come from making money. It comes from knowing you can't be destroyed. The turtles were writing feverishly, their earlier doubts replaced by realization. They had expected secrets, indicators, hidden edges. Instead, they were being handed something far more powerful: control. Dennis looked at them one last time. Feel your mind trying to complicate this, he said. That's your ego. Because if making money is this simple, then what have you been doing all this time? He closed the briefcase with the formula and smiled. Now you understand why the first rule of the turtle system isn't about entry or exits. It's this: don't bet your survival on being right. Who can tell me the fastest way to go broke? Dennis asked on day 3 of training. The room of young traders fell silent. Then, from the back, someone called out, averaging down. Dennis smiled faintly. Close, but not quite. The fastest way to go broke is adding to losers. And the fastest way to get rich is adding to winners. We call it pyramiding. The traders exchanged confused glances, adding more to winners. That sounded reckless. It went against everything they'd been taught. Everyone knew the golden rule: cut losses, let winners run. But Dennis wasn't talking about letting winners run. He was talking about building them up. He turned to the whiteboard and drew two columns: traditional trader on one side, turtle trader on the other. The traditional trader, he said, buys 10 units at the 100. Price rises to 110 and fear takes over. He takes profit, afraid to give it back. But the move continues to 150. He's out, watching, missing the big wave. Then Dennis wiped the board clean and grinned. Now let me show you how the turtles did it. He wrote, start, tense at 100, risk 2%. Price rises to 1, so 255. We add 8 more. Price rises to 105. We add SPIS. Price rises to 7.5. If we add 4 more, 28 units. He tapped the marker against the board. Same initial risk, 5 times the profit. That's how I turned thousands into millions. A murmur ran through the room. Jerry Parker leaned forward. But what if it reverses right after we pyramid? Dennis smiled and nodded to his assistant. Show him the math. The assistant walked to the projector. 10 units at his 100, stop at the 98 minus 2n. Add 8 units at 102 to 50 move all stops to 100 by 5. Add 6 units at 105, move stops to 103. Add 4 to 50 and move stops to 105 to 57. He paused, then continued. If price reverses from 107 fee to hit the stop at 105 and 5,000, the first 10 units make 55 profit. The second 8 units make the 30, the third 6 units make the 5, and the last 4 units lose my 8. Net profit for 82. Even though your last ad lost money. The traders stared speechless. The math didn't just make sense. It flipped their world upside down. The idea was powerful. You could be wrong on most additions and still make money, because when you're right big. Dennis stepped forward and spoke with quiet conviction. This is how the big money is made. Not by being right more often, but by being bigger when you're right. He looked around. Some traders looked excited. Others looked uneasy. Then he added the line that would test every mindset in the room. But pyramiding only works with trends. And trends are rare. He let that hang in the air. That means you'll spend most of your time losing small amounts, waiting for the few huge trends that make your entire year. Can you handle that? The silence grew heavier. The students shifted in their seats. Because this wasn't about strategy anymore. It was about psychology. Could they really accept being wrong 60, 70, even 80% of the time? Could they take small losses day after day, trusting the math, waiting for that one massive move that would make it all worthwhile? Most traders can't. They crave constant action. They want to win now. But professionals, they know patience is the price of wealth. They protect their capital ruthlessly. They stay small when uncertain and get big when right. That's the secret. Not prediction but discipline. Not emotion but execution. Dennis turned back to the board and underlined a final line with force. Don't add to losers. Add to winners. The words echoed in the room like a challenge. Most traders blow up because they chase validation. They keep adding to losing trades, desperate to prove they're right. But the turtles learned that mastery isn't about being right. It's about managing risk, stacking strength, and trusting the process. As the class ended, Dennis looked around one last time and said, if you can stand being wrong most of the time, and still act like a professional, then you can make millions. If you can't, the market will teach you the hard way. And with that, he walked out, leaving a group of traders forever changed. The math was simple. The mindset wasn't. Pyramiding wasn't just a strategy. It was a test of patience, courage, and faith. Because the real question wasn't whether the system worked. It was whether you could handle the truth behind it. 2 weeks of intense training were finally complete. It was January 16, 1984. The day theory turned into reality. The turtles were about to trade real money for the very first time. Dennis stood before them and said, some of you will get $250 in accounts. Some will get $100 million. Some will get $2 million. This isn't play money. Lose it, and it's gone. The room went quiet. Every turtle felt the weight of those words. Curtis Faith, just 19 years old, the youngest of the group, could hardly believe it when Dennis pulled him aside. You're getting $2 million, Dennis said. Faith blinked. Why me? Dennis smiled. Because you have no bad habits to break. And because you asked the best questions during training. The first trading day was surreal. The hum of market data filled the room. Jim Melnick sat frozen at his desk, staring at the flickering screens. I went from making $30,000 a year to controlling $1 million, he recalled later. My hand was shaking when I placed my first order. The initial results came fast, and they weren't pretty. By the end of week 1, 5 turtles made money. 18 lost money. The average loss. The biggest winner for 3.2%, Curtis Faith, The biggest loser, my 4.1%, caused by nervous overtrading. Dennis reviewed the numbers with a calm smile. Perfect, he said. Most of you lost money. That's exactly what should happen when there are no trends. The turtles looked confused. Perfect, losing. But Dennis knew. The goal wasn't to win every trade. It was to follow the system. Still, knowing the theory and living the reality were two different beasts. Michael Cavallo's week 2 journal entry told the story. Took a signal in soybeans, stopped out. Took signal in Swiss franc, stopped out. Took signal in crude, stopped out, down 47,000 in 5 days. The system feels broken. This was the first real test. Would they trust the system or trust their feelings? Then came February 8, 1984, the day that would define them. Heating oil broke out. Every turtle got the same signal. But what they did next revealed everything about their psychology. The faithful, those who trusted the system, took full position size. Curtis Faith 15 contracts, Jerry Parker 12, Paul Rabar 10. The fearful, scared by recent losses, reduced their positions, taking only 5 to 7 contracts. 2 traders skipped the trade completely. Then, the market exploded. Heating oil surged from 0.94 to 1.228 over 3 months, a monster trend. The results were staggering. Curtis Faith, who pyramided aggressively, made over $3.2 million. Jerry Parker, who pyramided moderately, made $1.8 million. The reduced-size traders earned $400,000 to $600,000, and those who skipped the trade, they made nothing and carried the psychological pain of regret. At the quarterly review, Dennis made the lesson unmistakably clear. The traders who followed the system made millions. Those who used discretion made thousands, or nothing. The message hit hard. The turtles realized trading wasn't about being smart or lucky, it was about discipline. About executing a system even when emotions screamed otherwise. Dennis leaned on the desk and looked around the room. You see, he said, the difference between $3 million and zero isn't intelligence. It's trust. Trust in the process. The turtles nodded quietly. Some were proud. Others felt the sting of hesitation. But everyone understood. This was just the beginning. The markets were ruthless teachers. The real challenge wasn't learning the rules. It was sticking to them when the pain started. As Dennis dismissed the group, he left them with one final thought. Feel that tension between logic and emotion, between knowing what to do and actually doing it. That tension decides your future. It's what separates those who get rich from those who only end up being right. Section 8 Teach PSYC Olabagoaf Sagamage, March 1984. The heating oil trend was over. Now the true psychological battle began. Success changes people, and in trading, it can change them faster than anything else. By late 1984, the turtles had survived the grind, endured the pain of systematic losses, and now, they were making serious money. But that success was about to test one of them harder than any losing streak ever could. Curtis Faith was on fire. He had turned his 2 million account into more than 10 million. Month after month, his trend following trades exploded higher. Currencies, commodities, even bonds. Everything he touched seemed to work. He was young, confident, and brilliant, maybe a little too brilliant. I started thinking I was smarter than the system, he later admitted. The rules got me here, but I thought I could improve them. Just a few tweaks. That's how it always starts. One justified exception. One signal skipped because the market looks overextended. The first slip seems harmless. Then it becomes habit. It happened in November 1984. A perfect breakout appeared in the Japanese yen. The system screamed buy. But Curtis had his doubts. The chart looked too obvious. The move felt too crowded. So he skipped it. A week later, the yen exploded upward, a clean textbook trend. His missed signal would have earned him $1.2 million. That was the first $1 million mistake. But worse, it wasn't about the money. It was about belief. When you break the rules once, it becomes easier to justify the next time. By December, Curtis was picking and choosing signals, applying his intuition. And intuition in trading is just ego in disguise. Then the reversal came. A false breakout in the British pound. The system triggered a short position, but Curtis, still trusting his gut, doubled his normal size. The trade reversed violently. In 2 days, he lost $1.8 million. Just like that, half of his recent gains were gone. He couldn't sleep. His confidence shattered. He wrote in his journal, "The system was right. I wasn't." At the review meeting, Dennis didn't yell. He didn't need to. He simply said, "Curtis, you broke rule number 1. Don't think you're smarter than the system." Then he turned to the group. When you start believing you can outsmart the rules, you've already lost. Because trading isn't about prediction. It's about process. The lesson cut deep. Every turtle felt it. It wasn't just Curtis's mistake. It was a warning to them all. The moment you let your ego trade, the market will find a way to humble you. The $1 million mistake wasn't just a loss of capital. It was a loss of clarity. Curtis later said, "That loss saved me. It hurt, but it reminded me who was really in control. The system, not me." The turtles learned that discipline isn't tested when you're losing, it's tested when you're winning, because success whispers lies. It tells you that you are the genius, that you can bend the rules. But the market doesn't care who you are, how much you've made, or how confident you feel. It only rewards consistency. Dennis summed it up perfectly in one line. You can lose money following the rules, but you'll lose everything breaking them. The $1 million mistake became a permanent part of turtle legend. A reminder that in trading, the moment you stop being a student, you start being a victim. October 19, 1987, the day the markets broke, the Dow Jones Industrial Average crashed 508 points, over 22%, in a single session. Billions evaporated before traders could even blink. Phones jammed, prices vanished, and panic took over. For the turtles, it was the ultimate test of everything they had learned: system, discipline, and emotion. The chaos began early. Futures were already limit down before the market even opened. It was like watching an earthquake, recalled Jerry Parker. No bid, no floor, just falling. Richard Dennis gathered his traders in the Chicago office. "This is it," he said. "This is what we've trained for. Follow the rules. Don't think, don't flinch." While the world screamed crash, the system simply triggered signals. Shorts on the S&P, bonds and currencies, all firing at once. The turtles executed mechanically. Orders were sent, stops placed, positions sized exactly by the formula. No emotion, just execution. But the emotions came anyway. Curtis Faith later said, "The hardest part wasn't watching prices fall. It was watching everyone else panic and doing nothing." Phones rang nonstop, brokers shouted. CNBC blared headlines of financial apocalypse. Some turtles were physically shaking as they entered orders, but they followed through. By the end of that brutal day, most global portfolios were bleeding. Hedge funds down 30%, mutual funds collapsing, retail traders wiped out. Yet the turtles were up. Curtis Faith at 22%, Jerry Parber 18%, Paul Robarth at 25%. How? Because trend-following systems don't predict crashes, they respond to them. The system had flipped short weeks before, and while the world was frozen in disbelief, the turtles were already positioned for the fall. "We didn't have to be smarter," Faith explained. "We just had to obey." But not everyone did. A few newer traders, scarred from past volatility, second-guessed the signals. They reduced their size or skipped the shorts entirely. When the market collapsed, they missed the move and watched their discipline crumble with it. Dennis addressed it bluntly the next day. "This is why emotion kills traders. You can be right for 6 months and still blow up in one moment of hesitation. The market punishes hesitation more than error." The lesson was brutal but unforgettable. Black Monday wasn't just a financial event. It was a psychological X-ray. It revealed who truly trusted the system and who only believed in it when it was convenient. Tom Shanks put it best: "Following the rules when you're comfortable is easy. Following them when the world's burning, that's mastery." As the dust settled, the turtles realized something profound. Their profits weren't the real victory. Their composure was. Every chart, every loss, every sleepless night of 1984 had prepared them for this one moment. The system didn't save them. Their discipline did. Dennis closed the post-crash meeting with words that became turtle legend. "The markets can crash, brokers can fail, governments can intervene. But your rules are forever. The moment you break them, you've already lost." The turtles nodded, exhausted but victorious. Black Monday had destroyed fortunes across the globe, but for the students of Richard Dennis, it proved a truth more valuable than money itself: systems don't fail, people do. The financial world declared it over. Trend following is dead. The headlines screamed it, fund managers echoed it, and retail traders moved on to the next shiny thing: high-frequency algorithms, smart beta machine learning. The era of mechanical breakout systems seemed finished. For nearly a decade, trends vanished into endless chop. From 2011 to 2019, markets moved like they were trapped in invisible walls. Breakouts failed, stops triggered. Systems bled small losses month after month. The old guard, the disciples of Richard Dennis, faced a new kind of pain: boredom. No crash to survive, no rally to ride, just slow erosion of confidence. It was psychological torture, Jerry Parker recalled. You weren't losing big. You were dying by 1,000 paper cuts. Investors demanded innovation. Adapt or die, analysts said. The turtle-style trend followers were mocked as dinosaurs in a digital age. Even within the community, doubts spread. Maybe volatility's gone for good. Maybe algorithms killed the edge. Maybe this time, the market really changed. But the few who had lived through the 1980s smiled quietly. They'd heard those words before. Trend following isn't dead, Paul Robarth told his investors. It's just resting. His logic was simple: markets are cyclical, not just in price, but in behavior. The absence of trends was itself a setup for their return. During those years, the temptation to optimize became unbearable. Funds layered on filters, predictive models, machine learning tweaks. They built systems that were faster, smarter, and ultimately more fragile. The ones who stayed true to the core DNA, simplicity, robustness, patience, were ridiculed for their stubbornness. But they understood something deeper. The system's edge wasn't prediction, it was persistence. Curtis Faith once wrote, "When nothing works, that's when faith matters most." By 2019, the pressure reached its peak. Many funds shut down or pivoted away from pure trend following. The media delivered the final blow. Decade of decline for CTAs. But history has a cruel sense of irony. Just months later, in early 2020, the world flipped. The COVID crash hit, volatility exploded, trends returned with a vengeance. The dead systems came roaring back to life. Those who had abandoned discipline missed the decade's biggest moves. Those who stayed doubled, tripled, multiplied. Chesapeake Capital posted record returns. Old systems written in the 1980s outperformed modern AI-driven models. The lesson was timeless: markets evolve, but human nature doesn't. The same emotions, fear, greed, impatience that fueled 1987 were alive in 2020, and as long as humans trade, trends will live. Jerry Parker summed it up in one line: systems don't die, traders do. The decade of death became the ultimate proof of life. The traders who endured the boredom, the drawdowns, and the ridicule rediscovered the essence of turtle wisdom: the system works if you do. The market's silence was never the end. It was just the test before the next storm. The original turtles had proven that trading discipline could be taught. But their students, the second generation, would prove something even greater: that systematic thinking could evolve and dominate in a world more complex than Dennis ever imagined. The 1990s had been about survival, the 2000s about adaptation, the 2010s about endurance, the 2020s revolution. Out of the ashes of trend following is dead, a new breed of traders rose, the systematic architects. They weren't coding from scratch, they were building on turtle DNA. Jerry Parker mentored dozens of young quants, teaching them not how to predict, but how to persist. "Our job isn't to know the future," Parker said. "It's to be positioned when the future arrives." These new traders blended old principles with modern tools. Cloud computing replaced spreadsheets. Python replaced graph paper. Monte Carlo simulations replaced back-of-envelope math. Yet the philosophy remained the same: trade small, trade consistent, trust the system. Salem Abraham expanded his family's legacy fund into a fortress of diversified systems. Trends in commodities, currencies, rates, even crypto. Richard Dennis taught the rules. Salem said, "We taught the code." The beauty of the revolution wasn't complexity, it was integration. Instead of one giant system, the new generation ran dozens of micro-systems, each specialized, uncorrelated, and self-adapting. Long-term trends, short-term breakouts, volatility harvesting. Machine learning wasn't used to predict prices, it was used to manage behavior, detecting when traders were likely to interfere. The system evolved to protect the trader from himself. That was the true breakthrough. Funds like Quantica, Transtrend, and Abraham Trading began delivering consistent returns in environments where others failed. While Wall Street fought for milliseconds, the system traders quietly compounded wealth by doing what turtles always did: cutting losses, letting winners run, ignoring noise. Curtis Faith, now an elder statesman of systematic thinking, summarized it beautifully: "The new generation doesn't trade differently. They just express discipline through better tools." But the revolution went beyond trading. Turtle philosophy spilled into entrepreneurship, venture investing, and even life design. "Systemize everything" became the mantra. Fitness habits, time management, all optimized like trading systems. The same logic that governed risk management now governed daily life: define the edge, size the bet, control the downside. In a world addicted to prediction, systematic thinkers thrive through preparation. By 2025, second-generation turtles controlled billions in assets. But more importantly, they carried forward the unbreakable principle that freedom is earned through rules, not rebellion. Jerry Parker called it the paradox of mastery. The more disciplined you are, the freer you become. And as global markets moved faster, louder, and more chaotic than ever, the descendants of the turtle experiment stood calm, proof that even in an algorithmic age, human discipline remained the ultimate edge. The experiment hadn't just created traders. It had created a mindset that outlived every market cycle. The turtle story was no longer just history, it had become a blueprint for the future. The second-generation revolution wasn't about changing the rules. It was about remembering why they worked. And that's why, even decades later, the turtles and their students still walk the markets with quiet confidence. knowing that true mastery isn't in prediction, but in patience. They never met Richard Dennis. They never sat in that smoke-filled Chicago conference room where the original turtles were born. Yet somehow, they may have gone even further than their teachers. The second generation of turtles didn't inherit money. They inherited a mindset. They learned from books, interviews, bootleg cassette tapes, and if they were lucky, from the first generation themselves. But what made them extraordinary wasn't blind imitation. It was evolution. The story began with Salem Abraham, a young Canadian grain elevator operator with a small 50,000 stake and a massive dream. In 1988, Salem read an article about Jerry Parker, Dennis's star pupil who had turned thousands into millions. Most people would have been inspired. Salem picked up the phone. "I'll work for free," he told Parker. "Just let me watch." Parker was amused by the audacity. Few had the courage to ask. "Come on down," he said. For 6 months, Salem slept on a friend's couch in Richmond, Virginia, sitting quietly behind Parker's screens, absorbing everything. "I learned more in those 6 months than in 10 years of trying alone," Salem said later. "Not about entries or exits. Anyone can learn those from a book. What I learned was about patience, about sitting still when every cell in your body screams to act. That's the real skill." When he returned home, Parker handed him $100,000 in seed money. Salem launched what would become Abraham Fortress Capital, a fund that would grow to manage over $500 million. But here's the beauty: he didn't copy Parker. He evolved the system. He used longer-term signals, 55-day breakouts over 20-day exits instead of 20 or 10. He focused on fewer markets, only the most liquid, to manage size and risk. He added an options overlay, selling premium during sideways markets to generate income when trends were sleeping. Same turtle DNA, new expression. That theme, personal evolution within timeless principles, defined the entire second generation. Kevin Bruce, a former engineer from Texas, learned directly from Paul Rabar. He started small, just $200,000 in 1995. His insight: commodities trend cleaner. There's less manipulation, more fundamental push and pull. He avoided financials completely. No bonds, no currencies, just grains, metals, and energy. His performance spoke for itself. From $200,000 to managing $300 million by the early 2020s with an average annual return of 18%. His rulebook was short: trade the breakout, size by volatility, add to winners, stop asking questions. Then there was Elizabeth Shevel, daughter of Liz Shevel, one of the first female turtles. Elizabeth didn't want to trade everything. She wanted mastery over a few. "My mother traded dozens of markets," she said. "I trade 3, S&P, NASDAQ, and Russell, depth over breadth." She refined turtle principles for equity indices only, incorporating volatility targeting and trend filters. Since 2001, she's averaged 22% compound annual growth, proving that focus can outperform diversification when backed by discipline. But the true innovator of the new wave was Marcus Chen, a coder from Singapore who studied under Curtis Faith in 2016. When others laughed at the idea of turtle-style crypto trading, Marcus leaned in. People said crypto was too volatile for trend following. He recalled with a grin, "That's like saying the ocean is too wet for swimming. Volatility is what we trade." Marcus adapted the turtle rules to 24/27 markets, smaller position sizes, no overnight gaps, tighter lookbacks due to shorter data histories. He treated Bitcoin and Ethereum just like any other market: price, volatility, breakout, stop, repeat. Within 5 years, his account grew from 500,000 to 50 million. "Crypto isn't different," he said. "Humans still panic and chase. Trends still exist. Math still wins." What truly separated this generation, however, was their culture of openness. The original turtles had secrecy in their blood, contracts forbidding them from revealing the system. The new turtles, they shared everything. Salem Abraham started a podcast breaking down trend-following logic for everyday investors. Kevin Bruce launched a YouTube channel explaining how he managed risk during commodity shocks. Elizabeth Shevel built Women in Trading, mentoring female traders globally. Marcus Chen went one step further, open sourcing his crypto trend following framework for anyone to use. The first generation proved it worked. Abraham explained, "We proved it's timeless. The third generation will prove it's universal." Through them, the turtle philosophy spread like a living organism, adapting to new environments without losing its DNA. The core principles remained unchanged: risk 0.2% per trade, never more. Base position size on volatility, not emotion. Trade the breakout, not your opinion. Add to winners systematically, cut losses mechanically. Ignore everything except price. But the new lessons refined it further: start smaller than you think. Focus on flawless execution over constant optimization. Community beats isolation. Teaching others strengthens your own discipline. Systems are personal at the edges but universal at the core. Success isn't an event, it's a process of aligned repetition. Notice the evolution. The first generation fought to prove the system worked. The second generation learned how to live it. They discovered that mastery doesn't mean perfect copying. It means principled adaptation. The best students didn't just follow rules. They reinterpreted them through their own psychology, their own markets, their own strengths. And in doing so, they became teachers themselves. Each new generation refined the system, not by changing its core, but by expanding its reach, from commodities to crypto, from private funds to public education. And perhaps that's the greatest sign of mastery, when knowledge outlives the teacher, adapts to new worlds, and continues to win. Not because it's complicated, but because it's true. That's the legacy of the second generation, the evolution of a philosophy that began with a bet in 1983 and became a movement by 2025. The turtles proved traders could be made, their students proved systems could evolve, and their successors. They're proving that discipline never dies, it just finds new forms. The evolution of turtle trading from the 1980s to 2024 tells a remarkable story, not of changing rules but of changing tools. What began with chalkboards and calculators has become a world of algorithms, cloud analytics, and AI-assisted dashboards. Yet despite the revolution in speed, precision, and access, the central truth remains unshaken: the power of turtle trading has never come from technology. It has always come from discipline. When Richard Dennis and Bill Eckhardt trained the original turtles, they gave them a simple system, a method built entirely on price breakouts, position sizing, and emotional control. There were no secret indicators or hidden formulas. The edge came from the ability to follow those rules in the face of chaos, fear, and greed. 40 years later, the modern turtles have access to technology Dennis could never have imagined: automated systems, machine learning forecasts, cloud execution platforms. But their challenge is still the same: to stay disciplined when the world moves too fast. Salem Abraham, trading from his high-tech barn in Canada, embodies this balance. His setup looks like something out of NASA: 6 monitors, automated position sizing, and real-time analytics tracking 50 markets simultaneously. What took hours in 1983 now takes minutes. But Abraham insists that technology only removes friction, not emotion. The decisions are still the same. He explains, all the tech does is speed up the math. It doesn't make the rules easier to follow. This perspective defines the true second and third generations of turtles. They've built powerful systems but remain humble to the simplicity that made trend-following work in the first place. As Marcus Chen puts it, automation can execute a signal, but it can't build conviction. His crypto trend-following system runs 24/7, yet he reviews every trade manually before confirming entries. For him, the human moment, the click of submit, is sacred. The modern turtle faces new psychological traps. Over-optimization is one. With access to massive computing power, it's easy to torture data until it confesses a perfect-looking system that fails in live markets. Kevin Bruce warns, you can backtest yourself into bankruptcy. Technology gives the illusion of control, but the market still humbles you. Then there's information overload. The original turtles had one price feed. Today's traders face a flood of data from Twitter, Bloomberg, Reddit, and endless screens of charts. The new discipline isn't finding more information, it's filtering it out. Ironically, speed has become both a blessing and a curse. Markets move faster, but trends still unfold over weeks and months. Abraham points out, just because we can trade faster doesn't mean we should. Patience still pays. Automation tempts traders to act, not to wait, and waiting is where the edge lies. The modern turtle must resist the illusion that more activity equals more profit. And yet, amid all the technological noise, the principles that made the original turtles successful have proven timeless. Risk small, 1-2% per trade. Size by volatility, add to winners, cut losers fast, and let the data, not your feelings, dictate action. These truths have outlasted every innovation, every market crash, every AI headline. On the desk of 68-year-old Paul Rabar sits a weathered HP calculator from 1983. It still works and he still uses it occasionally, not for necessity but for remembrance. This is how Dennis made $200 million, he says. All our fancy computers just help us do the same thing faster. The edge was never in the hardware. It was in the mindset. And that is the final lesson of modern turtle technology. You can automate the math. You can upgrade the infrastructure, but you can't automate discipline. The future of trading will always belong to those who master themselves before they master the machine. Marcus Chen's idea sounded insane at first. Sitting in Curtis Faith's living room, the youngest of the original turtles now turned mentor, Chen laid out a bold proposal. Crypto is the perfect market for turtle trading, he said with conviction. It's the 1970s commodities all over again, volatile, inefficient, trending, emotional. Everything the original turtles thrived on. Faith frowned. It's manipulated, unregulated. Could go to zero overnight. Chen smiled. So was silver when the hunts cornered it. You still traded it, and made millions. Faith leaned back, half amused, half curious. Chen had spent 2 years studying under him, absorbing every nuance of systematic trading, position sizing, and emotional control. Now he wanted to prove that turtle principles weren't tied to any one market, they were universal. His thesis was simple yet radical: crypto markets operate 24/7, offering continuous data flow with no gaps. Their volatility, retail participation, and inefficiency made them fertile ground for trend following. It's not about Bitcoin, Chen said. It's about price movement, and crypto moves like nothing else on earth. In 2017, Chen put everything on the line, 500,000, a mix of savings and family funds. His test universe, the top 10 cryptocurrencies by market cap. His system, pure turtle principles with 3 crucial adaptations. 1. Faster signals, 10-day breakout for entries, 5-day for exits, reflecting the nonstop nature of crypto markets. 2. Smaller risk, 0.5% per trade due to extreme volatility. 3. No pyramiding, until he fully understood crypto's behavioral rhythm. In the frenzy of 2017's crypto boom, Chen's trend system captured nearly every major move. Bitcoin up 400%, Ethereum up 1,000%. Every breakout was working. He wrote in his journal, "I'm up 900% for the year, it feels too easy." But he knew the danger of euphoria. As the 1980s turtles learned, markets that rise too fast collapse just as violently. Then came the crash. Bitcoin plunged from 20,000 to 3,000. Ethereum fell over 90%. Crypto is dead. Yet Chen's drawdown, though painful, was survivable. Q1 to 18%, Q3 to 50%, Q4 10%, full year to 47%. Still better than buy and hold at 85%, Chen noted. And I'm still standing ready for the next trend. His faith in systematic discipline paid off. While others swore off crypto, he refined his system instead of abandoning it. By 2019, Chen had made key improvements. He focused on Bitcoin and Ethereum as core positions, deep liquidity, cleaner trends, and avoided small cap altcoins vulnerable to manipulation. He managed risk through reduced weekend exposure, multiple exchanges, and by keeping half his profits in fiat to guard against regulatory shocks. Then 2020 hit, the perfect storm: pandemic panic, money printing, and institutional adoption. Chen's refined turtle model caught every major move. Bitcoin surged from 5,000 to 65,000, Ethereum from 100 to 4,000. Altcoins multiplied tenfold. By late 2021, his 500,000 account had grown to 50 million. Same math as soybeans, Chen laughed. By breakouts, size by volatility, ride the trend. The asset doesn't matter, math does. In 2022, as liquidity vanished and markets collapsed, Chen gave back 40%. But unlike most traders who were wiped out, he survived. His system was built for drawdowns. Crypto traders think they're different, he observed. They're making the same mistakes commodity traders made in the 70s. Predicting bottoms, ignoring trends, sizing by emotion. Chen's experiment proved something profound: markets change, but human behavior doesn't. Volatility is opportunity, if sized correctly. Mania and panic create the most profitable trends. FOMO kills traders in every generation. Now Chen mentors a new wave of crypto traders. In his workshops, he shows them 1980s soybean charts beside 2021 Bitcoin charts, identical shapes, identical emotions. The patterns are timeless, he says. Because people are timeless. Think crypto's too risky, too volatile. That's exactly what they said about commodities in 1983. The turtle edge isn't tied to the market. It's tied to the trader who can follow rules while everyone else loses their mind. Curtis Faith once said, "Everyone can follow rules for 10 trades. Maybe 20 if they're disciplined, but somewhere between trade 20 and 100 the real you emerges." In 2019, addressing a room full of aspiring traders, Faith revealed what truly separates success from failure. Not intelligence, not indicators, but endurance. Your first 100 trades aren't about profit, they're about transformation. The pattern of every new trader. Faith's data from thousands of students revealed a consistent journey. Trades 1 to 10, the honeymoon phase. Enthusiasm high, confidence booming, rules followed perfectly. Most traders even profit here due to sheer focus and beginner's luck. Trades 11 to 30, the first test. The first losing streak arrives. Doubt creeps in. 70% begin tweaking their systems, convincing themselves they're improving them. Trades 31 to 50, the fork in the road. A major drawdown hits. Half quit, a third jump to a new system. And only 20% persist. Trades 51 to 75, the darkness. The losing streak deepens, and so does emotional pain. Most believe the system stopped working. Only 10% still follow their original rules. But then comes trade 76 to 100, the transformation. Those who endure begin to see discipline transform into habit. The system reveals its long-term power. By trade 100, you're either a systematic trader or you're broke, Faith said. There's no middle ground. The 100 Trade Challenge. Faith formalized this journey into what he called the 100 Trade Challenge. Step 1, Setup phase. Write your rules in 1 page or less, no complexity. Define your exact entry, exit, and position size. Fund the account only with what you can afford to lose. Your tuition. Step 2. Execution phase. Take every signal, no exceptions. Follow position sizing exactly. Exit precisely when the rules say. Document everything, entry, exit, and especially emotion. Step 3. Tracking faith spreadsheet template. Forced brutal honesty. Each row, trade number, market, signal type, entry, exit, P&L, emotion score, and rule violations. By trade 50, Faith said, you'll see your psychology laid bare. Do you skip trades after losses? Oversize when confident, chase missed moves. Your data will expose you. Real transformations. Maria Gonzalez, a schoolteacher from Spain, took the challenge. Her first 20 trades followed rules perfectly, up 8%. Then came the slide, 3 rule breaks, minus 12%. Next phase, tweaking the system, minus 18%. Finally, she humbled herself and returned to the original plan. By trade 100, she caught a massive trend, 45%. Final result, flow 23%, but more importantly, a new identity. Trade 67 was my turning point, she said. 7 losses in a row, I wanted to stop, but I followed the rule. That one trade turned into a $50 winner. That's when I became a trader. James Park, an engineer from Korea, was even more disciplined. Until trade 88. After 87 perfect trades, he doubled his size from greed and lost 8% in one hit. He instantly returned to discipline and finished full 31%. That one mistake taught me more than 87 perfect trades, he said. The market punishes arrogance instantly. What changes by trade 100? By the time serious traders complete 100 trades, their mindset rewires. Emotional detachment from individual outcomes. No urge to predict. Comfort with uncertainty. Faith in statistical edges. Discipline no longer feels forced. It's automatic. You stop being a person who trades. Faith said, "Arn become a trading system that happens to be human." Those 100 trades are not about making money. They're about becoming someone who can. Every losing streak, every temptation, every mechanical rule followed against emotion builds the foundation of mastery. Feel overwhelmed by the challenge. Good. It should feel hard. Because at the summit of those 100 trades, you're no longer chasing profits. You've evolved into a trader who deserves them. 5:47 a.m. the alarm goes off, same time it has for the last 15 years. Salem Abraham sits up immediately, no snooze ever. People think trading from home is freedom, he says. It is. The freedom to be more disciplined than any boss would ever require. Welcome to a day in the life of a modern turtle. A systematic trader who follows strict rules, not emotions. 5:47 a.m., the non-negotiable wake. Abraham believes how you start the day defines everything that follows. The market doesn't have a snooze button, he says. Neither do I. 6:00 a.m. the scan. With coffee in hand, he reviews overnight movements across 47 markets, currencies 8 pairs, commodities 22 markets, indices 12, crypto 5. I'm not predicting anything. I'm just observing. Did anything hit a 55-day high? That's all I need to know. 6:30 a.m. the calculation. His Python script runs automatically. Markets at 55-day highs 3, markets at 20-day lows 2. Current positions 14, risk budget left 8 units. 7:00 a.m. the sizing. This is where most traders fail by thinking, not following. Natural gas flashes a buy signal. Account 12 million. Risk per trade 1% to 120 2,100. Position size of 57 contract. Most traders say, it looks explosive, let's make it 75. That thinking leads to bankruptcy. 7:30 a.m. the orders. 3 new positions. 2 exits. 12 minutes total. That's it. The work is done. Now comes the hard part. 8:00 a.m. to 3:00 p.m. the waiting. This is what nobody sees. The boredom, the restraint. 8:00 a.m. workout 45 minutes. 9:00 a.m. reading markets. History 10:30 a.m. a check fills 5 minutes. 11:00 a.m. journal. 20:00 p.m. lunch walk, no screens. 1:00 p.m. personal projects. 2:00 p.m. meditation. 20:30 p.m. final market check. 6 hours of waiting. That's the job, sitting while positions swing hundreds of thousands of dollars, doing absolutely nothing. The psychological warfare. Today crude oil have 127k, euro 2089k, cotton 4030k, net in 81k. The amateur would be panicking, adjusting stops, reading news. The turtle, I go for a walk. 3:00 p.m. the review. He updates his tracking sheet, reviews any rule violations, usually 0, and shuts everything down. Trading ends at 3 p.m. The market runs 24/7, but I don't. The hidden battles. What the internet never shows. The missed dinners, the lonely hours, the constant battle against boredom. The hardest part isn't losing trades, Abraham admits. It's doing nothing while your positions decide your fate. The monthly reality check. Work time 80 hours a month. Waiting time 400 SLA. I make millions spending 80% of my time doing nothing, he says. Try explaining that at a dinner party. That's the paradox of systematic trading. Wealth built not from constant action, but from disciplined inaction. And that's why 95% of traders fail. They crave excitement, turtles. They crave edges. How do I become a funded trader like the turtles? Jerry Parker had answered this question for years. In 2023, he finally decided to lay out the exact path. From zero to managing other people's money. It's not about finding a Richard Dennis to fund you, he said. It's about becoming someone worth funding. Phase 1: Build your track record. Months 24. Starting capital required at $10,000 minimum. Less than that and you can't trade properly. More than that and you'll trade carelessly. The proof system: open an account with a major broker, use third-party verification, and trade systematically for at least 24 months. Document everything. Nobody cares about your paper trading results, Parker said. Real money, real results, real verification. Expected results: year 1, anywhere from 10% to 30% while learning. Year 2, full 15% to 5% as consistency develops. Expect at least a 20% drawdown. Typical win rate 35%. 4-5 phase 20: build your business infrastructures. Months 18-30. While building your track record, start preparing for the business side. Form an LLC or corporation, register with your state, open business accounts, and hire a securities attorney. Compliance preparation: take the Series 3 exam for commodities, Series 65 for securities, register with the NFA if trading futures, and your state if required. The cost: reality, legal setup 1,015,000, exams and registration 1,000, ongoing compliance wars and 3,000 per month. Total first points 20,000 to 50,000. This is where dreamers become professionals, Parker noted. The costs and complexity eliminate 90% of wannabes. Phase 30: find your first million. Months 24-36. The 3 main paths. Path 1: friends and family. Easiest to get, hardest to keep. Start with 100K to 500K. Clear agreements are essential and expect some relationship strain. Salem Abraham began here. Uncle gave me 100,000. I lost 20% in 6 months. Thanksgiving was awkward, but I survived and he made it all back plus 400%. Path 2: seed capital firms. These fund traders with verified track records, typically done 5 million to start. You keep 20%, 30% of profits while they provide infrastructure. Seeders want to see 24 full months of real, verified results and a systematic approach, explained Kevin Bruce, who went this route. Path 3: direct institutional. The hardest path but with the best terms. Requires a 3 full year verified track record and at least 50 million AUM potential. You earn 1%, 2% management fees and 20% performance. The pitch deck: reality. Parker outlined what works. Slide 1: track record graph. Slide 2: system rules. 1 page. Slide 3: risk management and position sizing. Slide 4: drawdown analysis. Slide 5: team. Slide 6: terms. No predictions, no macro views, just results and process fees. 4A. The brutal truth: 50% of new funds fail in year 1, 80% by year 3. Only 10% ever reach 100 million and 1% reach 1 billion. Why they failed: inability to handle client psychology, system changes after drawdowns, burnout, compliance issues, and over-reliance on one person. The success formula. Parker's advice: trade exactly the same at 100 million as you did at 100 million. Communicate boringly but consistently. Hire operations before you need them. Turn away wrong fit clients. Preserve capital and drawdowns above all. Real numbers from real managers. 62K revenue, 130K expenses, 60K net. Live on savings. Year 3 over 200K revenue, 400K expenses, 200K net to finally profitable. Year 5100 MBU or net revenue. A 1.5M expenses, 1.5M net real wealth. It takes at least 5 years to build a real business, Parker concluded. Most quit at year 2. That's why most never run funds. Feel daunted by the timeline and costs. Good. This isn't a get-rich-quick plan. It's a build wealth systematically blueprint, the modern turtle way. After 40 years, what have the turtles really learned? In 2023, the surviving original turtles gathered for a rare reunion. The wisdom in that room represented billions in profits, millions in losses, and decades of experience. Curtis Faith stood first. If I could tell my 19-year-old self one thing, it would be this: the money is the easy part. Staying human is the challenge. Jerry Parker on success. I thought making millions would solve everything. It doesn't. It amplifies everything. If you're unhappy poor, you'll be unhappy rich, just with better toys. Paul Robar on longevity. I've traded the same system for 40 years. People ask if I'm bored. Bored. I'm free. Free from decisions, free from stress, free from prediction. Systematic trading gave me freedom. From trading. Liz Shivel on balance. The market taught me when to hold on and when to let go. That lesson saved my trading account and my life. Know when to exit everything, including trading itself. Mike Carr on wealth. First million excited, 5th million confident, 10th million anxious, 20th million philosophical. True wealth is knowing when you have enough. Tom Shanks on failure. I've lost more money than most people see in a lifetime. A 10 million in a day, a 30 million in a month. You know what? Still here, still trading, still grateful. Survival is success. The unified theory of turtle trading. After hours of reflection, they distilled 4 decades of lessons into principles. Market principles: markets trend 30% of the time. Catching 3 to 4 big trends per year is enough. Missing one can ruin your year. Position sizing determines survival. Exits matter more than entries. Psychology principles: discipline beats intelligence. Systematic beats discretionary. Boring beats exciting. Patience beats action. Process beats outcome. Life principles: money amplifies who you are. Success requires sacrifice. Balance prevents burnout. Teaching completes learning. Exit strategies apply to life too. The surprise is after 40 years. They expected trading to get easier. It didn't. Money to bring happiness. It didn't. Success to feel fulfilling. It didn't. They thought they'd trade forever. They didn't. What actually happened? Trading became automatic, but never easy. Money brought options, not happiness. Success felt empty without purpose. Most found meaning beyond the markets. The modern application. Salem Abraham, representing the second generation, said, "The original turtles proved the system works. We proved it's timeless. The next generation will prove it's universal, across all markets, all timeframes, all technologies." Marcus Chen, the crypto turtle, added, "Whether it's soybeans in 1983 or Bitcoin in 2023, the math is identical. Buy strength, sell weakness, size by volatility, ride trends. Everything else is noise." The final challenge. Curtis Faith closed the gathering. "We've given you everything. The rules, the sizing, the psychology, the path from zero to millions. Only one question remains: will you actually do it?" Knowing and doing are different universes. We've shown you the bridge. Walking across it, that's on you. The room fell silent. 40 years of wisdom condensed into one truth: the system works. The only question left: will you? Give me 90 days of perfect discipline, and I'll give you a lifetime of systematic thinking. Curtis Faith designed this blueprint after teaching thousands of aspiring traders. It's the exact path from amateur to systematic professional. Days 1-3 of the foundation phase. Week 1 system design. Days 1-20 write your complete trading rules. Entry criteria is like a 20-day breakout. Exit criteria is 10-day low or similar. Position sizing formula and markets to trade. 1 page maximum. If it's longer, Faith says it's too complex. Days 3-4 backtest your rules with at least 100 historical trades. Calculate win rate. Expect 35%, 45% and average win-loss ratio to verify positive expectancy. Days 5-7 set up your infrastructure, brokerage account, tracking spreadsheet, price alert system, and daily routine schedule. Week 2 mental training. Days 8 and begin daily 10-minute meditation. Read Trading in the Zone by Mark Douglas. Write your trader's constitution. Days 11-20 visualize following rules perfectly and handling losses calmly. Plan responses to different scenarios. Create a pre-trade checklist. Week 3 paper trading preparation. Days 15-7 open a demo account funded with a realistic amount. Set it up exactly like your real account. Practice order entries and test position sizing calculations. Days 18-20 take your first paper trades. Follow every signal, size positions by formula, document every decision. No real money yet. Week 4 building habits. Days 20-24 establish your daily routine. Wake at the same time, check markets at the same time, calculate signals systematically, and end trading at a set hour. Days 25-80 stress test your discipline. Trade when tired, emotional, or after losses. Prove your system's independence from mood. Days 29-3 review month 1. Analyze paper trades, note rule violations, calculate results, and prepare for month 2. Days 3 and Sydney. The execution phase. Weeks 5-6 systematic paper trading with a minimum of 20 trades. Perfect rule following required. Document emotional state and review weekly performance. Common challenges. This signal doesn't look good. Take it anyway. I should increase size. Don't. Let me check the news. Don't. Maybe I'll skip this one. Never. Week 7-8. Advanced scenarios. Practice handling multiple simultaneous signals, pyramiding, correlation management, and drawdowns. By day 69 at least 40 paper trades, 0 discretionary decisions, positive expectancy proven, emotional control established. Days 61-9 of the integration phase. Weeks 900 begin micro real money trading. Fund your real account with an amount you can lose without emotion. About 10% of your normal size. Focus on execution, not profit. Your hand will shake. Faith warns. Your heart will race. You'll want to watch every tick. Don't. Place the trade and walk away. Week 11 gradually scale. If you've executed perfectly, scale to 25%. Any rule violations, drop back to 10%. Keep documenting everything. Join a trader community for accountability. Week 12 full integration. By days 85-90 trading becomes automatic. Emotions are calm. The system feels internalized. You're ready for a lifetime of consistent rule-based execution. The 90-day success markers: at least 50 trades completed, paper and real. Positive expectancy verified. 0 emotional trades in 30 days. Routine established. Support system in place, written plan memorized. Confidence in the system, not outcomes. Real success stories. Anna Rodriguez, nurse. Day 1, terrified of losing. Day 90, calm and methodical. I didn't just trade systematically. I started living systematically. David Kim, programmer. I'd failed twice before finding this blueprint. The difference was structure. By day 90, I wasn't thinking about trades. I was executing automatically. Common failure points. Days 50, 20v first losing streak. Days 35, 4v boredom sets in. Day 61's in fear with real money. Day 75, temptation to increase risk. The lifetime habit. 90 days builds the habit. Faith concludes. 900 days builds the fortune. 9,000 days builds the legacy. It all begins with day 1. Reading this is your moment of choice. Start tomorrow or stay the same. The market doesn't care, but your future does. You've just absorbed 40 years of trading wisdom. The exact system that created multiple millionaires, the psychology that sustained them through chaos, and the blueprint for your own transformation. Now comes the only moment that matters. Right now, as you read these words, markets are moving, trends are forming, opportunities are emerging, fortunes are being made by systematic traders who were once exactly where you are. They weren't special. They weren't chosen. They simply made a decision and followed through. You have two paths. One is to close this script, search for the next holy grail, and continue the cycle of hope and disappointment, staying exactly where you are. The other is to accept that you already have everything needed, begin the boring, difficult, profitable work of becoming systematic, and transform your trading and your life. Somewhere right now, a trend is starting that will run for months. A systematic trader is quietly taking the signal. Discipline is being rewarded with profits. Someone is building generational wealth with simple rules. Will that someone be you? Tonight, write your trading rules on one page: entry, exit, and position sizing. Nothing fancy, just clear rules you can follow. Tomorrow, start your trading journal. Trade number 1 begins your 100 trade challenge. Paper or real, it doesn't matter, starting matters. This week, join a community of systematic traders. Isolation kills more traders than losses. Find your tribe. If you follow the system for 100 trades, truly follow it without deviation, you will be transformed. Not might be, will be. The math doesn't lie. The edge is real. The only variable is your discipline. Years after the turtle experiment, Richard Dennis revealed one last insight. I didn't really teach them to trade. I taught them to trust. Trust the math. Trust the process. Trust themselves to follow simple rules. Everything else was details. That trust is now yours to claim. Don't let this be another video you watch and forget. The turtles succeeded because they acted. Knowledge without action is worthless. Right now, make a commitment. Not to me, not to anyone else, but to yourself. Type in the comments, Day 1 biggest nobu awam tiswastum. Then start tonight with one simple rule, one position size calculation, and one commitment to discipline. Because in 90 days, you'll either be a systematic trader, or you'll still be searching for secrets that don't exist. The turtles proved that ordinary people can achieve extraordinary results. They lit the path. Now it's your turn to walk it. Welcome to the way of the turtle. Your transformation begins with 3 words. Day 1 begins. The market is waiting. Your fortune is calling. Your systematic future beckons. All that remains is for you to answer. In the end, we are all self-made, but only the successful will admit it.